edit the term sheet based on their consent, but then once you agree and it is frozen, then nothing beyond that can be modified. Now, before you prepare the term sheet, there will be, or maybe after the term sheet, there will be something called due diligence. Due diligence is a very common phrase that is used in industry, or maybe particularly in banks. Whenever banks want to extend any credit to a company, suppose you are a startup, you have approached to a bank, so bank will do some kind of a due diligence. Suppose you want to take over a company, then you do a due diligence on the target company that you want to take over. What is due diligence? You try to understand the details of the company, whether any information is suppressed, whether anything that has not been told and it may go against the prospect of the company. Suppose you think that company has a good prospect and company doesn't have any other liabilities, etc., etc. So you try to study in detail, you try to do some kind of a intelligence, meaning you try to like inquiry, a very deeper inquiry, so that nothing is hidden anywhere. Whenever you take over a company, or if any other or in any other context, some company is investing in another company, they would like to know that everything is clear, everything is visible. Suppose there are some outstanding dues with some party, say you have purchased material and you are yet to make payment. So someday or the other, this party is going to chase you and get the payment. If they don't get, they are going to go to court, and then there will be, they may even get a decree for liquidation of the company. So there will be no company at all in that event. So you would like to know, or investors would like to know, whether there is any such pending payment or litigation. Say somebody has filed a case against quality. Say you are either a pharmaceutical company or maybe a company that is producing say food items. So somebody ate your food and had some kind of a health issue. They have filed a case for maybe $50 million. Now, if you suppress that information before selling the company, you would like to, because this is a huge sum. So the prospective investors would like to identify those hidden information, or even not, say you tell them that okay, there is a case pending in the court, but then it is hardly anything because they don't have a point. They won't be able to influence the court, or we are at a firm footing, so there is nothing to be worried about. But then investors will not take your words just like that. They would like to see the depth, at the depth of the case, and they want to eliminate all the doubt that are there against prospect of the business. So that is due diligence. Due diligence actually is to eliminate all the doubts. So there will be a checklist for every investor. There are checklists. There are checklists, meaning about finances there will be one list, about legal problems there is a list, about say how you manage your employee relationship. So this is known as uh, something called I forget the name. So how means, suppose you have fired an employee. Now the employee is supposed to get maybe say uh, some kind of parting money, maybe some kind of a provident fund, or maybe as per the employment terms, the employee has to be compensated for maybe say 1 month of salary, or maybe 6 months of salary. You never know. There may be different conditions with different employees. Now suppose one employee is supposed to get 1 year's salary. You suddenly terminated his condition, his employment. Now he is in the process of communicating to your company that pay me my 1 year's salary. So that may be something like say 50 lakh rupees. Now, if you suppress that information before your investors would like to eliminate those kind of doubts. So they normally are not trying to catch you on the wrong foot. They want to eliminate all the doubts. That is the philosophy. So they want to be as comprehensive as possible, because they don't want to keep anything untouched or unexplored. Suppose there is something like a case where you are supposed to pay 5 crore rupees. and investors could not identify that. They took over the company. Maybe they paid almost say 10 crore rupees to take over the company. Immediately after they took over, this guy comes out and they say that I'm supposed to get 5 crore rupees. If you don't pay me, I'm going to go to court, and not only you have to pay money to lawyers, eventually if the verdict goes against you, you have to pay 5 crore rupees to this guy. So whatever 10 crore you paid, maybe you have to pay another 10 crore. So there will be nothing left. So you understand what are they looking for. Some of the key areas, like I said, checklists. One of the list is overdue tax liability. Suppose there is some GST liability. You have not paid GST to government, which you are supposed to pay. Now there is a litigation, or there is no litigation, but government is yet to catch you. So this guy want to see whether there is any overdue tax. Maybe government is yet to wake up, but the moment they will wake up, they will charge not only the tax, they will charge a penalty also. So it will be double or something. So overdue tax liability. Inadequate systems. Inadequate systems means, as I said, your employees, your relation with the customers, relation with the suppliers. Like say suppliers has already supplied goods and you are yet to make payment. Then inadequate system also indicate business process management. Like suppose you say that our business is doing wonderfully well, but then maybe your system is faulty, and to put things back to normal may require a lot of investment. So they want to see that everything is operating as per rule, as per business ethics, as per sound strategic principles, etc., etc. So if that is not there, they are going to charge a penalty for that, or they are going to reduce the value for that. Related party transaction. Suppose you have maybe something like, normally related party transactions are like you pay something to your dad, to your mom, to somebody else in a business transaction. Suppose you are occupying a premises that belongs to your dad. Perhaps your dad gave it free, but you want to just show some transaction and take away some money from the business to your personal account. So you show as if your dad has given this house on rent, and you are paying 1 lakh rupees of rent every month. So you are actually siphoning out money from business. So that is not something good. Maybe you hired a car from your wife, or maybe your brother-in-law or somebody. So all these are related party transaction. Another related party transaction is, suppose your brother has a company. Now you actually do not have the sales that you are showing in your balance sheet profit loss account. In your profit loss account, you are showing your sales is 5 crore rupees a year, but this sales actually is fake. How you are showing the sales? You are selling it to your brother's company. This is only book sell. You are just raising an invoice. Your brother is receiving that. He is showing as if he has received the goods. He did not receive any goods actually in reality. But in your books of accounts, you are showing that you have performed a sales. So these are related party transaction. And if that is there, suppose you have made a sales of 5 crore rupees and all the sales are through your friends and brothers and sisters and relatives, then it is to be examined whether these are real sales or you have just showed it in books of accounts. So much of hera-feri happens, and there are so much of creativity that goes into manipulating the books of accounts that it's very difficult to catch people 100% of their fraud. Very difficult. Unhealthy reliance on customer suppliers. Like suppose just because you want to show some profit, you have told your customer that I'll pay you actual money, means under the table, but on the invoice you show less price, so that in my profit loss account I can show profit. Same thing can happen with suppliers. So eventually hold it for a while. There is some disconnection. Let me see how quickly it can restore. Yeah, I think we are back to normal. Hope you can hear me. Okay. So you understand related party transaction, unhealthy reliance with customers and suppliers. You may suppose you have a wholesale distributor. You tell your distributor that I am raising an invoice at a very high price to show profit, so that in your profit loss account you are actually showing profit, but you are paying some money to the suppliers in cash other than through proper channel. So you are actually incurring loss, but to show profit in your profit loss account, so that you can tell your investor that, look, I am actually making profit, so pay me high value, means value, my valuation should be very high. Most of the companies will be resorting to so many other innovative ways to buttress their valuation. Overdue accounts or unrecorded liabilities. You have borrowed some money, you are not showing that in your books of accounts, or maybe some people have purchased stock from you, finished goods from you, but you are not showing that these guys have not made payment to you. You are showing as if payment has been received. Immediate need for major expenditure. You may suppress that also. That will also indicate weaknesses. Now, what is VCs and what is venture capitalists, or say angel investors? VCs are actually they are private equity investors, meaning they invest mostly in equity or preference shares. They pool resources from multifarious parties, maybe say provident fund funds or gratuity funds. In US, there is something called 401k, meaning they are something like pension fund. So they pension fund also is invested in profitable businesses so that the employees can reap the benefit. So these venture capitalists will get the money from them and then invest in startups and multiply their money. And these are known as risk capital because they are investing not in big companies, meaning not in profitable companies. They're investing in companies which have high potential for growth, but at this point of time, they're not growing so well. So they have high risk perception, meaning they're not so much established in the marketplace. So the risky investment. So that is why these are the money that venture capitalists will be investing are risk capital. Angel, they're individuals or maybe group of individuals. They pool resources either from their own source or maybe sources other than them, meaning other people. And then they may form a consortium, like say 4 or 5 guys form an angel, or maybe even one person can become an angel. If some people are interested for 1 lakh rupees, perhaps I can work as an angel, but then angel invest in sizes of 1 crore, 2 crore. After 10 crore or so, VC starts from 10 crore. Sometimes they invest 5 crore also in early stage VCs. There are early stage VCs whose ticket size is slightly small, and then they are okay with early stage startups also, meaning they have slightly high risk appetite. Now you have to understand preference share quite thoroughly, otherwise rest of the discussion will be kind of difficult to understand. See, all that we know so far from the balance sheet that we have discussed is that there is on the liability side, first thing is equity and other equity, equity capital or equity shares and other equities. Someone is doing something else, please mute your microphone. Okay. Okay. So other than equity shares and other than equity shares and other equity, there is something called preference share. There is something called unsecured loan. All these are there on the liability side. What is preference share? Preference share is almost like equity share, or it is almost like debt. If you remember the balance sheet, like say on both sides here, there are assets. Oh my God, I won't be able to type. It's kind of, I'm not habituated. So this side is asset is going to take too much time. Okay, let me not try. So let me just erase it, will be better. So on the left side, Or say if it is a column shaped, then at the beginning there are assets, then liabilities, then sorry, in between there is equity capital. Now that is on the on the liability side. Just think of the liability side, don't think of the asset side. On the liability side, you start with equity, then other equity. Other equity is nothing but reserves and surplus. There is one part of the liability side of the balance sheet. Then comes long-term debt, short-term debt, then payables, accounts payable, meaning you have purchased goods on credit and you are yet to make payment. So that is also liability. Between other equity and long-term debt, there is something called preference share, which is not shown in the balance sheet. Why it is in between? Because it has some features of equity share, some features of debt. What is the features of equity share? Meaning the dividend that is, this comes with the condition that you have to pay some dividends. This is eligible for dividend. Eligible is a term. This is eligible for dividend, whereas debt is not eligible for dividend. Debt attracts interest. If you borrow some money from bank, that is debt, and you have to pay interest to the bank. So that is the structure of debt. Whereas for equity share, you have to pay only dividend if you so desire. If there is sufficient money, you can pay dividend. Whereas in the case of debt, you have to pay interest. But preference share is in between, meaning for preference shares, you have to pay dividend, but then this dividend is fixed. You have to compulsorily pay. Whereas for equity share, it is not compulsory. You may pay if there is profit, but on preference share, you have to compulsorily pay. Just like debt, you have to compulsorily pay interest. But like equity share, you have voting right. Preference shareholders do not have voting right. Likewise, there are many other distinctions between preference share and equity share, preference share and debt. What are they? It does not give voting right, number one, fixed rate of dividend, but are performance driven. Like suppose this year, suppose dividend is fixed at 10%. In a particular year, if you cannot pay 10% dividend, you may pay 5%, and the rest 5% you may pay later. You may pay entire 10% later whenever there is sufficient cash flow. Then it carries preferential rights over ordinary equity shares. If you remember, seniority of preference share is more than equity share. They comes first. In case of liquidation, preference shareholders will get the money before equity shareholders. Thus it ranks slightly above. Now we move to very important thing. This section is very important. There will be multiple questions in class test and final test. This section is very, very important, both from class test point of view and in future point of view. You have to really know this, whether you work in a startup, whether you start a startup or you work in established company. Some 25 slides or so moving forward are very important. So follow very carefully. One is pre-money, post-money valuation. Another is percentage holding. Now we'll discuss everything together. We have already discussed pre-money and post-money value. Suppose you start a startup. Now at some point of time you think that let us approach to an angel investor for money. Now suppose you have invested maybe whatever 5 lakh rupees or whatever, you have invested some money in the company, not 5 lakhs, say 1 lakh rupees. You three founders have invested 1 lakh rupees in the startup. Now after a while, after 2-3 months, you approach to an angel for 10 lakh rupees. Now the angel will come to your company. They will see whatever you have done. They will say, you are at idea stage. How do I give you money? There is nothing on the table. So the angel says, at the most, I see that whatever you have done so far, it can be valued only 5 lakh rupees. So angel values your company at 5 lakh, even though you have invested only 1 lakh. Why 5 lakh? Because you have added some intellectual property. Maybe you have written some code, or maybe you have done some market research and some early prototype or something. So Angel has valued your company at 5 lakh. Now you are asking for 10 lakhs. So he will say, okay, your pre-money value is 5 lakh. I bring 10 lakh. Done. Now you do the math as to how much percentage the angel will demand. Automatically, he will demand based on his share of the value. Remember this. He will demand equity based on his share of the value. Now pre-money value, that is your value is 5 lakh. He brings in 10 lakh. So total value becomes 15 lakh. After the angel brings in 10 lakhs, the value of the company goes up to 15 lakhs. Now out of 15 lakhs, angel means angel's share is 10 lakhs, your share is 5 lakhs. That is how percentage holding is decided based on value. This is different way of showing percentage holding. We will discuss percentage holding again very differently moving forward. This is one way of deciding percentage holding. Don't get confused. Here, based on valuation, angel has valued your company 5 lakh. He or she has brought in 10 lakhs. Total value has gone up to 15 lakh, out of which angel has given 10 lakhs and you have given 5 lakh, not in terms of money, but in terms of value. 10 lakhs of value attributes to angel. 5 lakhs of value attributes to co-founders. So angel will get 10 divided by 15 is equal to 66%. You will get 5 divided by 15 is equal to 33%. That is your percentage holding. Depending on percentage holding, now you have to give the shares. So far, we have not talked about shares. Now you have to give shares. We'll come to that in the next slide or next. Suppose the same example differently. Suppose on a different time frame, the same example, sorry, it is not another example, same example. After a while, say after 6 months, you have added a lot of value. Now you need more money. You need 45 lakh rupees. So the earlier angel, who was a poor man like me, and you say 45 lakh. So I'll say, sorry, I cannot give you 45 lakh. I don't have that money in my bank. So you say, okay, then let us approach to somebody else. So let us bring another angel. I said, okay, fine. Then that angel comes and value our company. Now it has become our company. You three and myself, we four. Now that angel comes and value our company at 1 crore rupees. The new angel comes and say, wow, you have added a lot of value. I value your company at 1 crore rupees. And you are asking for 45 lakh. Fine. I'll give you 45 lakh. Don't worry. So he or she gave us 45 lakh. Now total value becomes 1 crore 45 lakhs. Sorry. 1 crore 45 lakh. I changed the value just now. So that is what happens when things are done on the fly. So total value is 1 crore 45 lakh, out of which 45 lakh is attributed to the angel 2 and 1 crore rupees is attributed to myself and you 3. So we estimate percentage holding like this. New angel 2 has to get 45 divided by 1 crore 45 lakh. Again, something is wrong again. I think it is going to change. Okay, whatever, you try to understand. Don't look at the value. I divided 45 by 150. Earlier it was 150, so it became 30. So it is not 30. Now it will change. So it will be 45 divided by 145. 45 by 145 is 31.03. So this becomes 31.03, so this will become 68.97 or something. Most likely, I'm not sure. See, when I take a class, I become very nervous, and if I do some math, that goes haywire. So I have a bad name on that. Whatever, you just try to understand. The new value becomes 1 crore 45 lakh. And out of that, 45 lakh is attributed to the Angel 2. So Angel 2 is supposed to get 45 divided by 1 crore 45 lakh, that is 31%. And we 4 are supposed to get the rest, which is 1 lakh divided by 1 crore 45 lakh, which is 68.97 or something. Okay, that is about determining percentage holding based on value and the money brought in. Previous lecture, I told you percentage holding is not related to now amount of money that you bring. So these are contradictory because these are two different method of estimation. So please try to understand these two differently. Absolutely. Whatever I said today is absolutely correct. Whatever I said yesterday or in the previous class is absolutely correct. But there are two approaches. Let us move forward. We'll see that. Now, whenever you think of an angel or VCs, traditionally you may think that their percentage holding depends on number of shares, and in the balance sheet, whatever. So there is something called equity share. How many shares they are holding, how many shares we are holding will determine the percentage. And if we liquidate the company, they will get their percentage, we will get our percentage. If I ask any of you, you will say that, sir, I want 51% holding so that I have all the control of the company, and VCs may have 49%. So we kind of try to understand everything from percentage holding point of view. Now, suppose you sell your company, say for something like, say 10 crore rupees, you might think that I am supposed to get 51% of the sale process because I have 51% holding. And investors will get 49% of the money. So that is it. I get 55 crore and 1 lakh, and investors get 49 crore. I get, it is 10 crore, say 100 crore, they get 49, you get 51, whatever, simplistic. Okay, but it is actually not so. It is not so. There are many other conditionalities that are to be fulfilled, and this depends on three factors. One is something that is known as liquidation preference, another is called participation, and the third is forms of securities. I added this slide just right now. One is liquidation preference, another is participation, another is forms of securities. Securities means they are in the securities they have invested, like equity share is a security, preference share is another security, then debt instrument is another security. So it is the form in which they have invested the money. If they have invested in equity shares, that is one thing, preference share, another thing. If they have invested in debt, meaning they have given a loan, that is altogether a different thing. So depending on these three conditions, how much money they are going to get will depend. So let us move forward and see how. One of the two features of a preference share, if you have decided that we are going to take only preference share, not debt, not equity. So if it is preference share, it may come in many forms. One of the condition of preference share is liquidation preference. Liquidation preference, meaning that whenever a company will be liquidated, or suppose the company receives an exit for whatever kind, suppose somebody takes over the company, or you go for selling your company to somebody, or whatever happens, you sell your company either through a court decree or in a friendly takeover or something. If there is a liquidation preference, in that case, the investor will get their investment fast. They will take away their investment fast. Now, there may be different kinds of liquidation preference. One, there may be no liquidation preference. That means there is no liquidation preference, meaning they will not get any money return as towards their principal. Towards their principal, there is no refund, but they will still get some money. I'm coming to that. Second is 1x liquidation preference. That means whatever money they have invested, they should get that fast. Then whatever money will be left, they will see how much money they can take away from there. That is next. But liquidation preference indicates how many times of their investment they will get fast. Then they will take away another percentage of the remainder. Hold on for a moment. I'm going to explain. That is what is liquidation preference. There can be 10x liquidation preference, meaning that if somebody has invested 1 crore rupees, he will say, I have 10x liquidation preference. So give me my 10 times 1 crore, meaning 10 crore. Return me my 10 crore. If anything is left, then I will see how to distribute that. That comes later. Then there is participating or non-participating. If there is no participation, suppose there is 2x liquidation clause and no participation. So the investor will get 2 times whatever they have invested, and there is no participation. They will get nothing more. Now suppose there is participation. The moment there is participation, they will get a holding in the company. Like the example that I gave here, here. This 33%, 66%, these are participation, meaning they are participating in the equity. So whatever is their investment, they are deciding that my participation in the equity is 33% or 31% or something. But liquidation preference is away from that participation clause. Now, if it is non-participatory, then that 33% or something is out of question. There is no participation. Okay, they will only say that we have 3x liquidation preference, meaning whenever we will exit or the company will liquidate, we have to be returned 3 times our investment. Look at this first one. Angel invested 10 lakhs. So at any point of time, if the company is liquidated, they will get 3 times this money. That means 30 lakh. If the company is sold for 20 lakh, they will take all the 20 lakh because they have to get 30 lakhs. So up to 30 lakhs, they will take all the money. Suppose the company is sold for 1 crore, they will take 30 lakhs. Then you get 70 lakhs. That is how it is decided. We'll see a lot of examples. That is what is participating. Liquidation clause. Participating means they have holding in the company. It may be no liquidation clause, but participating. That means they will take only participate 33%. Suppose this company is sold for say 1 crore rupees. They will say that our share in the 1 crore is 66.67%. Give us the money, and whatever is left, you take away. That is fine. So they will take 66,67,000 rupees out of 1 crore. That is what is participating. And if there can be both. Suppose they have 1x liquidation preference and participating. So they will take their 1x, meaning they have invested 10 lakhs. They will take the 10 lakhs first. Then you are left with only 90 lakh. Out of 90 lakh, they will take 66.67%. And then whatever is left, you will get that. So you don't get 33% of 1 crore. You get 33% of 90 lakh. That is very important. So that is what is all those. Let us see some example. You will understand. I think this is already understood. This is also understood. Participating preference share with assumed 1x liquidation. Sometimes it is assumed, but normally you have to mention that in the term sheet. Suppose a new venture raises 50 million rupees at a pre-money valuation of 50 million. Pre-money valuation is 50 million and they have got 50 million. Obviously, the percentage holding will be split 50-50. If there is a participation clause, if there is no participation clause, then there is no 50-50 business. The founder holds or hold all the 100% of the equity if there is no participation clause. But if there is a participation clause, automatically equity will be split 50-50. Now suppose the venture is sold for 250 million. This selling thing is called liquidity event, meaning the company is sold. So if the company realizes a liquidity event whereby they receive 250 million, so the investor will get 50% of that, you get 50% of that, 125 each, gone, done. Okay. Now suppose it is participant. Earlier example, it was participating. So it was as simple as that. Now suppose there is both participating and 1x liquidation. Participating and 1x liquidation. So what are they going to do? In the same example, this example, let us remain here, will be better. This page is less cluttered. So they have 1x liquidation clause. If there is liquidation clause, that comes first. So out of this 250 million rupees, out of this 250 million rupees, they will take their 50 million rupees first because that is their investment. My God, where is the pen? I don't see. So they will get their 50 million rupees first before distributing anything. So 250 out of 250 gone. Now they'll say, okay, now we have participating. So out of the rest of the money, that is 200 million rupees, we have 50% holding. So we get 50% of that, that is 100 million. So they will take first 50 million, then 50% of whatever is left, that is 100 million. Why this data? I don't know. There is some extraneous material. This should be 200. Something is gadbad. They take 50 million plus 50% of the remaining 200. So that becomes 250 minus 150 is equal to 100 million, which you get. Entrepreneurs get 100 million. Some mistakes. Okay, so I think it's clear now.
I have one doubt here.
Can you hold it for a while? There are other examples. I think it will get clarified. Okay, let us have the doubt at the beginning itself. Tell me, that will be easy for me to clarify.
In case of non-participating preference share, it becomes same as the equity. Like the liquidation fee is decided earlier as like the debt, and I don't have any stake at the company during liquidation. So what is difference between debt and non-participating preference share?
Okay, good question. Suppose if the company is has a debt, there's some, I mean, try to understand holistically will be better. If you means an investor, you are the angel. Suppose you have invested in debt in the company, you have given a loan to the company. Your preference is always first. Suppose there is a bank loan and you have preference equity, it is always better to have a loan rather than preference share, because the liquidation proceeds means the debt holder will have senior claim to the proceeds. So if you have given a loan to the startup, you stand to gain if it is loan. But if there is no bank loan, then there is hardly any difference. Meaning if you are giving a preference share which is non-participating, but you have 1x liquidation clause or 2x liquidation clause, this number of x will make a differentiator. I think you understand this. If it is debt, suppose you have given 5 crore rupees to a startup, you will get only 5 crore. But suppose you have 2x liquidation clause of preference share, and the company means company is liquidated, you will get 2 times the money that you have given. This is the only difference. You get it?
Yes, sir.
Hello?
Yes, sir.
You
Got
got it. Okay. Otherwise, there is no. Suppose that this is 1x liquidation clause, then there is no difference between debt and preference share without participation. But now, if there is a bank loan guy, then there is a difference between preference share and preference share without participation and a debt, because you will be pari passu. Pari passu, if you understand, meaning you will be proportionately claimant with the bank. Suppose bank is supposed to get 1 crore, you are supposed to get 1 crore, and the company is sold only for 1 crore. Then among you and the bank, you will be sharing 50-50, because you are also a creditor to the company. Bank is also a creditor to the company. You have similar seniority. So that makes another differentiator. I hope the whole thing is understandable now. Now let us move forward. Let's move forward. We'll see if I get another chance to clarify this point. I think I have clarified in a complex manner. Even I am not satisfied. If the investee company issues stock at a price, okay, this is anti-dilution clause. Before I give more example, there are some other conditions which are there in the term sheet. Let me explain that. If it is if there is an anti-dilution clause, there are 2 points. One is the investor. Suppose you are an investor and you have invested and your investment has been converted into equity share at the rate of say 55 rupees a share. 55 rupees a share. Now your company is running well and not running so well, mota moti. Then you approach to another investor. And that investor tells you that, I can invest in your company, but not I can invest at 50 rupees a share, not 55. Now your earlier investor will tell you that, in my conditionalities, there is an anti-dilution clause that tells me that if you raise any money moving forward, that should be raised at a price more than the price that I paid. I paid 55 rupees a share. Now you have to raise money at a price which is more than 55 rupees. Now the company will tell, nobody is ready to pay me 55 rupees. What do I do? Then the investor will tell that, okay, give me some share at 40 rupees or 45 rupees so that my average price is same as the price of the present investor. If the present investor is investing at 50 rupees, my average acquisition cost should be 50, should not be above 50. That is one liquidation clause, anti-dilution clause. Another anti-dilution clause is that whenever some new investor will invest in your company, my holding should not go down. If you see this example, see, when another angel came, that angel took 68%. Now, founders and first investor will share only 31% of the equity, which is therefore the first angel who was holding 66% equity will now hold less than 31%, because the 31%, I'm sorry, this is investors holding. So out of 68%, now the angel's holding will be 66% multiplied by 68%. So it will be something like 40%, close to 40%. And rest will be with the founders. So 40, 31 and the rest with the founders. What, not 40, it will be 6 or maybe 7 value, 45% or so. 45%. Earlier, angel was holding 66%, whose holding will come down to something like 45, 46%. So angel's holding goes down as moving forward as you raise more money. Now, if there is anti-dilution clause that my holding will never go down. So whenever you raise money again, you have to allot new shares to the earlier investors, first investor, so that the first investor's holding will always remain 68 point something percent. 667%. But then the new investor may object. So that may work as a deterrent against raising new money for you. So you should be careful while reading the conditionality, terms and condition. If you find that there is an anti-dilution clause that says that his percentage holding will never change, you should immediately put your foot down and tell nothing doing. I am not going to sign on this dotted line, because your percentage holding has to go down proportionately as our holding will go down. Otherwise, I won't be able to raise money moving forward. The first one perhaps is okay. Average acquisition price should be below whatever you have raised is acceptable to some extent, not perennially, because at some point of time you will be raising money at a valuation of $100 million or maybe $1 billion. You won't be able to fulfill this condition. It will be very difficult. This average acquisition price, if you take into account, it will be selling the company to him for no money. Okay, these are the explanation of all those. Drag alone provision. This is very dangerous, meaning that whenever your investor will come up with a resolution, you have to just say yes. If they try to sell the company, if there is a drag alone provision, you have to only say yes. They will just wait for you to say yes. If you say no, then they will say go to whatever. This is not tenable. Now let us see some example. Now suppose a BA group invests 50 million rupees for 25% in the venture. Don't read the next line, just stay in the first line. A BA group invests 50 million for 25% of the venture. What do you understand? That means the value of the company is 50 million divided by 0.25. Because they have invested 50 million and got 25, that means 50 million is equal to 25% of the company. So far from discussion that I have made, you should understand this clearly. So 50 divided by 0.25 makes 200 million. That means the value, post money value of the company is 200 million. Forget about that. That is beside the point. Now the venture is sold for 100 million. For whatever reason, you could not sell for 200. You sold only for 100 million. Now, based on different conditions, let us see how much money you get, how much money the investors get. First is no liquidity preference. That means the investors will not get the principal back. They will get only the percentage of the money. How much money for which you have sold the company? 100 million. What is their holding? 25%. They will get 25% of 100 million. That means they will get only 25 million. Okay, they will get only 25 million. And they have invested 50 million. So they are going to lose another 25 million. That is the condition. So you say sorry, you invested 50 million, but you are going to get only 25 million. I'm sorry. But you will get the remaining 75 million because you hold 75%. But your story is rosy till now. Moving forward, you are going to cry or weep. Now, second condition, BA group has 1x liquidity preference and no participation. They don't have 25% holding. They have 1x liquidity preference. So when the company is sold for 100 million, they will say, okay, we are happy. You give us the 1x, meaning whatever we have invested, give me back. So you get only 50 million, not 75. Condition number 3, case number 3. BA group negotiate 1x participating preference, meaning 1x liquidation and participation. So they get 50 million of 1x as well as they get 25%. So at the beginning, once you get this $100 million in your bank account, the BA group comes on the table. They say, okay, 50 million this side because I have 1x participation. Give me my 50 million fast. Okay, you gave 50 million. Now on the table, there is another 50 million because you got 100 million. Now, out of this remaining 50 million, they get 25% because they have 25% holding. That is what is participating. So they get 12.5 million. So 50 plus 12.5, that means they get 62.5 million and you get 37.5 million only. So your story is getting marked here. Now suppose another example, almost same but with some different condition. They say BA group invest 50 million, get 25%, venture is sold for 100 million, same. Now post money valuation is 200, as I said, 50 million divided by 0.25. And what is the pre-money valuation? Because post money is 200, BA has brought in 50, remainder is pre-money, so pre-money is 150. Now suppose there are different conditions. Now BA group hold 25% equity. Suppose they have no liquidation preference, they get 25% because they have 25% holding, nothing new. Their original investment is 50, so they lose 50%, entrepreneurs get 75, this is a repetition. An example of reference share. BA group invests 50 million for 25%, the venture is sold for 50, same. Sorry, it is repetition. Case 2, 1x preference, oh, I think it is repetition again. Same thing, 12.5, same thing. I don't know how this is repeated. I'll delete this slide. I didn't notice. I thought I have given another example. Okay, now case number another. Say you have 2x participatory, meaning that they have invested 50 million, so they will get 2 times 50 million. So 2 times 50 million is 100 million. Now whether you have 25, 75%, irrespective of that, the venture capitalist or business angel will take all the 100 million. You will left with nothing. Get this point? So from 75 million, now your share has come down to 0. Let us change the times. This 2x, they get everything. So now I think you understand the permutation combination. I don't think we need to explain even further. Let us see. Suppose the venture is sold for 1000 million, meaning 1 billion rupees with 2x participatory as well as liquidity preference. Now see, this is a new example. This is not repetition. So 2x liquidation means they will get 50 into 2. They will get their 100 million first. So you are left with 900 million. So they get 100 million, you are left with 900 million. Now if they have participation, so they get 25% of the remaining 900 million. So 25% of 900 million is 225. So they get another 225. So earlier they get 100, now they get 225. So the total of 325. So they get total of 325. So they get 3.25 multiples of investment. No, sorry. 6.5 multiples of their investment. They invested only 50 million. They got 325 million. And the investors get, the founders get 1000 million minus 325. So they get 675 million. Gone. Usually, these are the share discussion. Now we are moving on to a different discussion. Usually everything is converted. Like say everything is converted to equity share. Whenever everything is converted into equity share, there is no liquidity preference. There is no liquidity preference. Liquidity preference is only with preference share. The term preference itself is indicative that it is about preference share. So you get, once it is converted into equity, it is all percentage holding. So if they are holding 25%, they get 25%. Nothing doing. Preference shares and convertible debt gets converted into equity. So sometime it will get converted into equity. At the beginning, they don't want, because they want to reduce their risk, but you are at risk. All that the investors have is the percentage after a while. Now let us not move further. If there is any question, let me attend some questions. I don't want to discuss more, because if I open a new chapter, that is going to be involving. So let me not, for the namesake. Okay, Arjun Malhotra is likely to talk to you on Sunday. because of many reasons. But I'm trying to take for permission on Sunday. And Arjun Malhotra, if you believe me, is the most or the best graduate from IIT Kharagpur. And he's a billionaire. He started HCL Computers and many other companies. He is managing a venture capital fund. In fact, his son is managing that. I have referred to him several IIT students who are toying with any idea of startups, and he mentored them thoroughly. And anybody who met him, anybody who attended his lecture is a different guy. He's a transformer. So you don't want to miss his lecture. So participate there. I'll send a link, a separate link, because this Microsoft link does a lot of problem. I don't know, maybe I have to create another account or something, or maybe I'll use some paid Zoom link or something. I'll see. I have to take help from Arjun maybe. So do participate there. Any question?
Sir, what is the syllabus for that?
Syllabus will be till say today's lecture. I have already sent the question paper. So there are some questions from today's lecture also. That's it. Meaning the question is with the Moodle now.
And sir, how many more classes will be conducted?
Ideally, I want to offer only 2 class tests, but then I want to give you a choice, like class test 1 and 2. The higher that you score between the 2 will be taken as class test 1 marks. The higher of the class test 3 and 4 will be taken as class test 2 marks. Then there will be a final examination that will be out of 40 marks. And I'm going to give you an assignment very soon. Maybe within this weekend, I'm going to define the assignment individually. No group assignment, individual assignment, and you have to submit individually, based on which I'm going to give 20 marks or something. Whatever I have told at the beginning, I'll follow that. And 10 marks will be out of attendance. I'm yet to see whether I should give an assignment instead of attendance, or maybe distribute 5 marks out of attendance, 5 marks out of. I'm yet to decide that. I'll see based on the type of attendance. I'll see that. We'll discuss. That's hardly anything. 5 marks is hardly anything. But major portion is that out of 2 class tests, I think it will be 20 marks. Out of 1 assignment, maybe 20 marks. Out of final test will be 40 marks. Likewise, I'm yet to. I don't exactly remember what I wrote in the class outlines that I sent to you at the beginning. So I'll see that. I'll revisit that and check. Whatever I said, I'll follow that. I'll not modify that. Anything else?